towards the end of last year and the beginning of this year, Oxfam published kind of provocative piece of research that showed that wealth the wealth gap and all of that is that inequality has widened further. The top 25 richest people, the top 25 billionaires have more than the bottom half of the planet. I think that was one statistic. More and more, I think people are building a conscience, and especially people that are ready to make investments, that are ready to kind of put their money in places, are getting kind of more socially responsible. And I think we touched on it a little bit at some point when I was learning about Sarwa in the early days. But what's your position, and what does Sarwa do in terms of offering socially responsible investments and things like that, in terms of being able to make sure that if we do put money on the market, it is going to the brands and to the organizations that are going to have a positive impact environmentally, socially, etc. Yeah. What do you guys do, or how do you help people that are kind of like me, who's super conscious about that stuff?
Yeah, that's great. And I would say overall, it's still a new wave in the investing space. I won't make it sound like it's super advanced and mature. We're constantly looking for, we preach diversification as a quick story. So we have diversification across asset classes, geographies, and companies. So you will invest in the US stock market, and we'll invest in real estate, we'll invest in bonds that are safer. So you could apply the same thing for a socially responsible portfolio. The same principles of diversification that typically have won. They won a Nobel Prize. So you can have these same principles for a socially responsible portfolio. So we help people build a socially responsible portfolios that have these principles, but exclude certain companies and industries like oil and gas, etc. Now, the great thing about, however, even if it's a new trend, one thing that I really love about socially responsible investing is that you're not paying a premium for it. And when you look at the correlation with the portfolios, it's a 98% correlation, which means it's pretty much the same thing. So you're not sacrificing returns to make that statement and encourage companies that aren't impacting our environment or are addressing the gender gap, for example. There are these portfolios that exist. Now, the reason they're still new is because it's difficult. You're still not able to say, for this specific cause or this specific company, I have a problem against that, remove it from my portfolio dynamically. There's still funds that have hundreds or thousands of companies, but it's making its way there. And since we started only in 2 years, we have seen fees drop for these portfolios. We have seen more exclusions. So we're seeing more activity from fund managers like Vanguard or BlackRock that are leading in the space. But as long as you're someone that's patient, I think you'll only see it improve. And the same way you live, your money can reflect the same thing.
See, I love this product. I love this part of your product, the socially responsible piece, because I think and Chris, you'll probably go into this more, but if you talk about being patient and investing for the long haul, then the trends that we're seeing today are that the more and more of these brands and companies are going to be available to people. And Chris, you've spoken about it previously on, with real value creation.
Talking about the trends. And that's where I was kind of going. I feel like what we've kind of been noticing, I guess Steve and I, we focus on this a lot, especially with DUCKLIFE and the clients that we serve as well. We're starting to see that it's no longer a question of, if a brand is a good, member of society and if they have a conscience. It's no longer about that. It's about the fact that consumers in general are now demanding that the products that they choose, that the services that they choose, are doing good for their societies and their communities. And it's overwhelming, insight that we're getting on the consumer side that's saying, especially now more than ever, if you look at the dialogue that's happening online of now in the back of COVID, when we come out of it, everyone's saying, I'm going to be a boycotter and a boycotter. I'm going to pick products that are in line with my values and helped my community more than ever, had a positive impact. I'm going to pick brands that also supported my environment. Now, so there is a trend on the consumer side. I just hope that on the investment side, that also scales in parallel.
Yeah, I think, socially responsible portfolios, I love that product as well. I wish it was more popular, but I think there's good momentum around it. However, I would say the biggest ethical point in investing, and this is where I guess motivates us in the morning as a Sarwa team, is the impact of fees and how retail investors are getting ripped off, especially in the UAE. You know, when we moved to the UAE 2 years ago, we were talking about our low pricing, pay less than 1%, and people were thinking, what's the catch? What do you mean pay less than 1%? I'm paying 4.5% for my saving plan, and it was a very nice gentleman with a suit that sold me this plan over 25 years, and if I want to get out in the next 10 years, I'm going to lose all my money. Like, what are you talking about? How is this legal?
So bankers.
While it's supposed to talk about values and ethics for socially responsible, what really gets us fired up is people that are getting completely ripped off, paying more than 4, 5, 6% in fees without even knowing, and being stuck in that product. Because imagine, you're, as a consumer, what we often find is, like, I hate that part of the meeting where, you know, you're telling someone, look, we can help you. You are, by the way, you are paying around 5% in fees at the moment. And they're like, what do you mean? They quoted me 1. And by the way, we cannot get you out until like 5 years from now because you would lose all your money. So anyways, that's a bit of a tangent, but I think in investing as well, we need to educate a lot of people about fees, because percentages sound low. Like, what's 1%, 2%, 3%? But in general, when you look at the same way returns can work for you and make you a lot of money, fees work the opposite way. And that's why we hate credit card debt, for example, because it's a guaranteed loss that you're incurring. And
so how do the fees work with Sarwa? So I mean, for the people listening that want to understand, so I know that you charge anywhere between 0.5 to 0.85 in terms of your fees. Mm-hmm. And those fees are on gains or on, you know, how does that work, and when are they charged, how are they charged, etc.?
Yeah, it's exactly that. So it's between 0.5% up to 0.85%. This is the only fee that Sarwa charges. The only other fee that the client pays is the cost of the fund that we use to invest. So this is the cost that that Vanguard or BlackRock, some of the fund managers we use. So overall, you're always paying less than 1%, because the other ones are max up to 0.15%. So we charge it monthly. So it's quoted yearly, billed monthly. The reason for that is we have certain banks such as HSBC that tell you, upfront 3%, and we hate that because you just lost 3% that you could have invested. So that's the rationale. And by the way, this isn't something that we came up with. It's very, very normal in wealth managers to quote that way and to work that way.
Okay, cool. And then and then with Sarwa, we can put all of our money today, and then a year later we can withdraw the entire amount.
Completely.
Completely.
So this we always say, this is your money, you work hard for it.
That's super important for me. I don't know why, but like, I want all my money. Yeah, but don't do it. You're an idiot. Yeah, but I still want all my money. I want to know that I can if I want to. You know what I mean? It's just that inherent fear. But,
I mean, it's the irony of that fear as well. Sorry, I'm going to jump in and be critical again of the current place where you're sitting, having that cash sitting. Because what is it today? And this brings us on to a good point, actually, with trust. What is it today that makes you keep your money in a bank when a bank could, in theory, and does in certain countries, stop you withdrawing and holding on to your cash flows? You know, with Sarwa, how do you build trust and establish that trust, especially in such an immature market when it comes to investing?
And before you answer, I just want to add another layer of complexity. Seeing that we are both Lebanese and have some Lebanese heritage, seeing that, Steve also has money in Egypt and in banks in Egypt. I think one of the biggest kind of factors for me that makes me nervous is the banking system. Not so much the investment part of it, but the ability to liquidate. And the trust that institution is going to give me access to my cash. Right now is the prime example. All the banks in Lebanon right now are not letting anybody pull out any of that. I hardly have a dime, they can keep it. Whatever I have in Lebanon, they can keep. But it is impossible to withdraw your own money right now based on the crisis of their market, etc. So how do you manage that? I mean, we haven't seen that yet in the UAE unless your visa expires. But how do you manage that kind of trust issue here in things that you don't necessarily have control of?
Great question. So I guess as a fact, like the short answer is this effect is devastating. As a story, this morning I woke up, I went to buy water, my debit card didn't work. I log in, the balance looks good, and I swear I had this mini freak out where I called the bank, and it turns out they stopped my card because I paid like 3 Etisalat bills, so they got worried. But it just gave me a small taste of like I cannot imagine what these people are feeling, but it sucks. The short answer is it sucks because you've obviously trusted the institution. Now that being said, the rates did reflect that environment. So we had a lot of cases when we started 2 years ago where I had one client who came to see me and said, you're telling me that overall I can make a 7% on average as a return, while this other Lebanese bank is giving me 10% guaranteed. Like what's the catch? And the answer I always give is there's no free lunch in finance, right? The only free lunch is diversification, and that's why it won a Nobel Prize. But in general, it's a very simple equation between risk and return. So when you have a guaranteed 10% return, and we see this a lot from clients from India and Egypt as well, where you have country risk, currency risk that is built in, there are signals. So in general, the first guidance to people listening is a guaranteed rate. Typically, you'll have 1% as a saving account, 1 to 2. Beyond that, you're not talking typically in a bond environment. So a globally diversified portfolio will typically return 7%. So anything above that, you should start to understand that you are taking significant risk. Now, how do you create trust? For us, we're not in the business of holding the client money. We're in the business of making it very easy to get invested and managing your money so that you don't need to. So we realize that as banks, they're not built to make great technology products, but they're good at what they do, which is to hold the money. However, we cannot just say banks. We need to look at region specific. So for our clients, currently we use Citibank, and we're allowed to use HSBC in either the US or London to make sure that you have the highest chances of that money being safe. It's the most developed financial system remains these two countries. So this is where we put your money. We don't hold it as Sarwa. We've plugged into them to make it very easy to open and hold your money there. But we're not in the business of holding money. So we create trust in a different way, which is through transparency, education, and explaining where your money is.